One of the biggest events in the markets last week was the transition of the US dollar into stage 4, which is a bear market in stage analysis. If you go to my stage analysis screening tool at screener.nextbigtrade.com, we can scroll down and see here that on the currencies page, the Swiss franc, Swedish krona, Australian dollar, Canadian dollar, and the euro are all in stage 1 now. And the Japanese yen has actually been in stage 2 for the past 10 weeks. This was the first currency to really break out against the US dollar. And the UUP, which is the most popular US dollar ETF, is now in stage 4. The only other currency that is also in stage 4 is the British pound. So you can see that there's been a lot of trend changes going on in the currency markets, and this should have a big impact on commodities and, in particular, precious metals, gold and silver. Now, if we go to the US dollar over the last couple of years, we can see that obviously we've talked about this in the past, but in 2014, the US dollar went into a tremendous stage 2 rally, which topped out in early 2015. And back here, I actually did a video talking about the bullishness and the parabolic nature of this advance and how it could be signaling a long-term top. And actually, ever since it topped in March 2015, the dollar's essentially traded sideways, consolidating these gains. Now, at first, it seemed like the dollar was trying to form support at the 30-week moving average, which you can see a lot of retests of the 30-week moving average back in 2015. Then it started to attempt to break up into a new stage 2 advance late last year, but a couple of different events, most notably being the Federal Reserve failing to get their rate raising cycle really into gear, as what's caused the U.S. dollar to start to be weaker against other currencies, which is why it started to break down here and actually transitioned into stage 4 over the past week, as it's now trading below its 30-week moving average, and the 30-week moving average is starting to trend lower. And you can also see down here that the dollar is now underperforming against the S&P 500, which was not the case over the past 2 years or so. So this, if this is a major trend change for the U.S. dollar, this is going to have a lot of repercussions for the rest of the market. Now, looking at the dollar longer term, it's notable that the U.S. dollar made a significant low back in mid 2011, and actually there was a lot of bearishness on the U.S. dollar back here, and the dollar hasn't made a low ever since, and it went into a brief stage 2 rally into 2012, but consolidated sideways before we had the big move higher in 2014. So it's been about 5 years since the US dollar has been in a bear market cycle. Now, if we look at GDX, it continues to break out in a stage 2 advance on high volume. We can see that after the stage 2 breakout in early February, it's done nothing but go up since then, although the advance has been kind of curtailed as we've had the U.S. stock market kind of take over some of the leadership in the market over the last month or so. But we can see the high volume on GDX. Last week it did almost 2 times average volume once again, and it's still outperforming the S&P 500. The chart of silver looks actually extremely bullish right now. We've got this inverse head and shoulders pattern forming, and we've had high volume in the SLV ETF in 3 out of the last 6 weeks, including last week. We did almost 2 times average volume with 55 million shares traded versus average volume right now is about 32 million shares. And the SLV is starting to outperform the S&P 500 as well. if silver can break out above 15 on the SLV, we might see this even ramp up further, and you might cause a multi-dollar move higher in the price of silver. GLD has basically consolidated sideways since it went into that big stage 2 push in early February. So it's been about the last 5 weeks now that we've traded sideways, and this market hasn't let the people that want to get back on board this bull market into the market, which is a sign of a strong bull market. Now, the HUI to gold ratio is important because this ratio shows that when gold stocks are outperforming or underperforming gold. And this ratio actually gave a good signal as far as the gold market breaking down in mid 2011 and starting up a new bear market. You can see that the ratio broke down here before gold actually topped in September 2011 and continued lower ever since, with some fake stage or rallies up to the resistance, but they always failed, and the bear market continued until this present day. But now the ratio is actually trading above the 30-week moving average, and we want to make sure this ratio stays above this 30-week moving average as this new gold bull market continues forward. And if this ever breaks down back below the 30-week moving average, we'll take that as a warning sign that the bull market could be in trouble. Now, there's been a lot of talk about the Commitment of Traders report and it being bearish for the precious metals market, but I'd like to show how this really wasn't the case at all compared to what we saw in the 2009 to 2011 rally in the price of gold. So one thing that the gold bears have been talking about recently is that the amount of short contracts against the price of gold has increased dramatically by the commercials, from 5,000 net contracts short all the way till over 200,000 net contracts short. And this might seem like a dramatic increase, but we've also seen a big increase in open interest, which means that the market is expanding and more players are coming into the market to take long and short positions in the price of gold. Now, if we go back to what happened in 2009 to 2011, the price of gold advanced from $900 an ounce to about $1,900 an ounce, so almost 100% or over 100% gain over a 2-year period. And let's look at what the commercial traders did, and we can see that the amount of net short contracts on the commercials reached 200,000 contracts back in June 2009 and stayed above that level all throughout 2009, and actually got up to over 300,000 contracts net short in late 2009. Then in 2010, the number of net contracts short stayed above 250,000 essentially for the entire year, and the price of gold continued to go up the entire year with some mild pullbacks to the 30-week moving average twice that year, once in January and then again in the summer. And again, the price of gold just kept going up the entire time. And in 2011, the price of gold continued higher all the way up until September. And we can see that in 2011, the number of net contracts short stayed above 200,000 during all that time in 2011 until September, where it finally tapered down to about 150,000 contracts short. And this is where the gold bear market started. So the idea that this ramp up in the commercial net contract short will cause an immediate move down in the price of gold is false, based on what we've just seen here with what happened back in between 2009 to 2011. To get more information on the stage analysis trading system, go to my website at nextbigtrade.com/stage analysis. I've also created a stage analysis screening tool at screener.nextbigtrade.com, and I can be reached on Twitter at nextbigtrade.